afternoon, Mr. and we are from Group 4, and today we will be presenting about the renowned investor Bill Lynch. I'm Kavina Sweet, and this is my group mates, Ginika, Akia, and Iqbal. Before we begin, let's look at the short video. Did you change the settings? Go to the speaker, and then change go to that. Your own. Bill Lynch underlines the importance of research before investing in any investment decision. So before we begin, Peter Lynch started his investment career in 1969 with Fidelity Management and Research Company. He gained the widespread recognition while he was managing the Fidelity Magellan Fund from 1977 to 1990. While he was managing the fund, saw a remarkable growth. Although right now he continues to work part-time as a vice chairman in the Fidelity Management and Research Company, he spends most of his time to mentor young analysts and also focus on philosophy. Now let's explore to Peter Lynch's investment philosophy. First, investing in what you know. According to Peter Lynch, he says that investors should invest in those companies that they understand its business model and fundamentals. Next, seek undervalued stocks with strong growth prospects. Peter Lynch wasn't just looking at any stock; he was looking at those companies they were trading below their actual value. Next, do your homework. Peter Lynch stressed on the importance of research, and more research. He encouraged people to analyze a company's financial health, economic growth, market potential, leadership, and competitiveness. This kind of deep dive into a company is going to help investors make well-informed decisions and avoid unnecessary risks. Now let's look at the track record of Peter Lynch while he was managing the Fidelity Magellan Fund from 1977 to 1990. First, let's talk about annual return. During his 13 years managing the Magellan Fund, he delivered an impressive annual return of 29.2%, far exceeding S&P 500's 16.53% during the same time. The fund's success came from Peter Lynch looking for undervalued stocks, which then turned into a multi-bagger investment. Second, fund growth. When Lynch took over the Magellan Fund in 1977, the company only had about $18 million in assets. When in 1990, when it stepped down from the role, it had about over $14 billion in assets, which makes it the largest mutual fund at the time in the world. This shows Peter Lynch's diverse portfolio, where at one point he holds over 1,400 different stocks. Highlights Lynch's diversification strategy. Next, public assets. Interestingly, the Magellan Fund was not even open to public until 1981. Once it was open to public, becoming a public mutual fund, investors flocked into it, driven by Lynch's impressive performance and investment expertise. However, despite the fund success, the average investor only earned about 7%. Why? Because many investors try to time the market, often buying high and selling low, instead of staying invested for a long run. That's all for the introduction. I'll pass it on.
Hi everyone, I'm Akia and I'll be talking about the biases related to the image. The first one over here is the overconfidence bias, which is a tendency where people believe that they're more capable. This can show up in three ways: overestimation, where people believe that they're more skilled; overplacement, where people believe that they're better than others; and overfixation, where we put too much trust in our own predictions. This is caused by lack of knowledge of previous success experiences or cognitive shortcuts, where people tend to repeat the same experiences they faced before. This can have effect in poor decision financial investments, which is business decisions and mistakes in daily life. As consequences, this can be the person can be having risk-taking behavior, under preparation or failure to learn from mistakes and financial losses. Buy what you know is the approach that Lynch suggested, or invest in what you know. If you can some talking about, I've been explaining before. So this approach can be a smart investment strategy, but this can also expose us to overconfidence bias. I will pass the floor to Gigi to further elaborate on this.
Before we look at the first strategy, let's look at a quote from Peter Lynch himself, where he said, "Never invest in an idea you can't illustrate with a real." So what he means by this is that if a business is too risky, if it's a business that is too complicated to explain, then it's too risky to invest in. This directly relates to the first strategy, which is the story approach. So for the story approach, Peter Lynch ensured that before investing in a company, he would do a 2-minute explanation, and if he can't do that, then he would simply avoid investing in the company. Where simplify investment decisions by explaining a company's growth potential in under 2 minutes. Avoid investing in companies that cannot be clearly or quickly understood. A perfect example of this would be the Dunkin' Donut investment, where instead of focusing on complicated financial jargons, he simply asked like basic common questions where, does Dunkin' have a loyal customer base? Is it popular? And he ensured that the investment decision was based on a clear and easy to understandable rationale. Okay?
The second bias is the loss aversion, which is a psychological phenomenon where people experience the more pain more intensely than the pleasure of gaining something equal. This is when people have emotional responses, aggressive behavior, and experience magnitude of loss versus gain. This is caused by avoiding risk and some transparency, which means that people tend to stick to bad projects even though they know that it's not good because they make too much investment in them. The effects for this bias is that people who make emotional investments, they will gamble and they have a reward effect. The consequences can be bad corporate decisions, tough negotiations, and non-rational economics, meaning there will be emotional responses. Focus on fundamentals on the loss. Being suggested to focus on fundamental losses instead of focusing on the loss, the key success is to learn and grow. I'll pass the floor to Gigi.
So once again, this is another quote from Peter Lynch where he said, "The real key to making money in stocks is not to get scared out." So what he means by this is that instead of focusing on short-term market fluctuations, you should focus on the stocks for the long term. So this directly connects to the second strategy, which is focus on fundamentals. Peter Lynch set apart on focusing on fundamentals, which meant evaluating a company based on actual financial data such as P/E ratios and debt levels. Where many of the other investors was focusing on short-term market fluctuation, Peter Lynch focused on long-term health of a company, ignoring the short-term market fluctuations. A perfect example for this would be the Ford Motor Company, where in the early 1980s, the auto industry was going through a market fluctuation. While many investors were scared to invest in it, Peter Lynch saw their financial data and he did a research and he found out that even though during basis, the Ford Motor Company still had a good financial data. They still had a reliable debt levels and a strong profit. So despite the market uncertainty, he still invested in the Ford Motor Company, and it became a huge success for him.
The last bias for our presentation is the status quo, which is a cognitive bias where people prefer things to stay the same, to avoid uncertainty, and they have a preference of familiarity and inertia in decision making. Inertia in decision making is basically a pattern where people tend to repeat the same things again and again. This is caused by fear involved social influence and cognitive gaze. Cognitive gaze is where they feel more confident in repeating the same experiences. This can have effect on personal finance, business strategy, or even healthcare choices. This can have consequences like missed opportunities, inefficiencies, and failure in business or in other investments. When it comes to Peter Lynch, he was hesitant about embracing technology at first and preferred the traditional ways because he wanted opportunity. However, as per sources, he later regretted not investing in it. Thank you very much. I'll pass it to you.
To overcome that business bias, Peter Lynch used a method called as Appleby method. So he believed that this method was all about gathering real-world information. So instead of just focusing on market predictions, he actually went to the stores and spoke to the customers and the managers to gather more information, to get the real-world information. This hands-on approach helped him to identify a company called Taco Bell. It was a great investment for him because he actually gathered insights from the fast food managers and the customers, and he found out that they have a loyal customer base. They were quick to serve their food, and their quality was still top-notch. He noticed that Taco Bell locations were always busy and had an efficient business model, while maintaining a good quality and making a popular choice among consumers. This leveraged competitors' observations to understand industry shifts.
Alright, I will be presenting about the lessons that we can take away from Peter Lynch. So the first one will be investing in what you know. Second, don't be afraid of losses. And thirdly is knowing when to let go. Okay, so the first set of the lessons are going to be financial based. So investing in what you know, the behaviors addressed here is the overconfidence bias, as we said before. So through thorough research, you may understand more about a company, and the more you understand about the background of a company and what's under the curtain, the more you're able to make decisions based more on personal experience. Because you can make decisions on stocks based on how you feel about the company, but if you know more about the company in the background, that will be even better because you have more of a chance of knowing if it's worth to invest in the company or not. And especially, a good product does not mean a good investment. What this means is that just because the product is booming at the time, does not mean in the long term it's going to be the product that everyone's wanting. Second lesson, don't be afraid of short-term losses. The behaviors addressed is the loss aversion. Investors sell too soon in order to avoid paper losses. As soon as people see prices start dropping, they will sell as soon as possible in order to cut their losses, they say. Well, stock price declines are very common in the investor side of the world, and long-term patience outperforms daily fluctuations. What this means, in a single day, a price may go up by a few cents. However, in the long term, in 1 year, the price may go up by a few dollars. So this is what it means when long-term patience outperforms short-term daily fluctuations. And thirdly, knowing when to let go. Status quo bias is the behaviors addressed. Investors tend to hold on to poor performing stock as they think letting go means failure. Now, investors, they will hold on to anything that they think will make them money. If I hold on to this stock for 5 more years, I'll make my money back then. Well, past ownership does not justify future holding. Just because you owned it in the past doesn't mean it should let it cost you for the future. Just sell and move on. Now, the second side of the lessons will be behavioral, what we can learn from him behavior-wise and use in our everyday lives as well. Keep it simple, right? Like what we said just now. Straightforward thinking, complexity does not mean better. in the business world, a complex business model doesn't mean it'll make money. And don't overcomplicate things. Make it simple. As the quote we said just now, never invest in an idea you cannot illustrate in crayon. This means just keep it simple. Stay humble. Everyone makes mistakes. Do not let your ego take over. Understand that in this world, everybody makes mistakes. You make mistakes, I make mistakes. Accepting failure and learning lessons from it is the best thing you can do. And he said, Peter Lynch said as well, in this business, if you're good, you're right 6 out of 10 times. And now for our final lesson is do your own thinking. Independent thinking. Just because that's what everyone is thinking does not mean it's right. Just because a group of people, just because the whole world is saying to go right, doesn't mean going left is wrong. Doesn't mean that you can't do what you want to do. And you know what you own, and so you own it. And yeah, so these are our references. And thank you.
Okay, so now we open the question to the floor. Any question?
Miss, I have one. Since you talk about the story approach, can you give another example of a company that follows the story approach?
I think it would be McDonald's. Just like Dunkin' Donuts, I explained earlier, they are also a fast food company. They have a well-recognized brand and they have a loyal customer base. So that would be another company for the story approach.
Okay, thank you.
Meaning that
It's
this
easy to
guy,
understand.
Peter Lynch, invested in McD.
Oh, no, it's just that they have the same thing. Like Dunkin' is easy to understand. His question was what is another company that would fit the story approach.
Oh, alright. Okay, next question. Okay.
How did Peter Lynch identify the value stock, the other value stocks? And can you give an example of one he invests in?
So Peter Lynch identified undervalued stocks by looking at the company's fundamentals and its growth potential. One of the main examples could be when he invested Pennyman in 1980s. It was undervalued when he first invested it, but not, later on it became one of the key contributors to Magellan's strong success.
Anything else?
Nothing.
Done? Okay. Alright. So now, let me go this. Okay. So I noticed that there is a quote that he mentioned, only invest in what you know, right? And then he put that on overconfidence bias. Don't you think that is familiarity bias? Because you only invest on what you're familiar with.
It's not only invest in what I think I didn't put that. It's invest in. Yeah, it's not a
This is on Akia. When Akia presented, he said only invest in. Can you go to the slide? This one also mentioned buy what you know, and then there is quote that he said one quote, I don't know, like at the beginning I think. He clearly said, never, don't invest in, not this one. The beginning when Akia invested, not Akia presented, the first one. First or second, I don't remember. But this one, but before that got one, okay? But there is mention on buy only what invest in only what you know. So instead of overconfidence bias, don't you think that is familiarity bias?
It can be actually both because when we're talking about overconfidence in this environment, people normally don't analyze properly because they think they already know. So that exposes us to overconfidence because they're not analyzing the whole fundamentals and not going through the financial statements or whatever. They already know. They think that they already know
They're very confident.
Okay, yeah, okay. And then what you can improve is just because you mentioned it can also be both, right? Okay, so I was expecting that when you mentioned overconfident bias, there's also familiarity bias. Okay, so you're looking on that. Okay, so that one, okay. Okay, on the, you mentioned on Ford Motor example, can you go on that slide? Jessica presented. And then two donuts investment. Okay, I will not, if you can add like data, okay, on Ford Motor, like how much, when you mention Ford Motor, it means he invested, right? Okay, so there's one slide that you really have a good data there. I think on the first slide, okay, you give like how much, how many billions, I think that's very good. Okay, so I was expecting the same here. Okay. So this feedback, you guys, when I give feedback, right, you guys can still improve it when you submit after 3 days, because we have 72 hours before you submit, right? Okay, so all of these things, okay, you can improve, okay, put in, okay, but not too much, okay, and then, okay, okay, so the only big part that I see here that you did not mention on familiarity bias, which is very significant to what you put most of the time here. Okay, so that, okay, if you wanna put it in, which on the content of presentation, but the delivery you might be working on that. Okay, but for the content presentation is okay. Okay, that's that. Okay, any question then? Clear on what my expectation is. Okay, so that's that. Okay, so thank you to